a lot of the ways architectural firms are structured, they're much more team oriented. And I think that works really well for ESOP companies.
Hello and welcome to the Business of Architecture. I am your host, Ryan Willard, and today I have the great pleasure of speaking with Phillip Hayes, who is a succession planning partner of Berman Hopkins. Now, Phillip joined Berman Hopkins' team in 2000 and became the succession planning partner in 2006. In 2010, he was named the managing partner. He transitioned his role as managing partner in 2020 to pursue his passion as the full-time leader of the firm's employee stock ownership plan, otherwise known as ESOP, practice, and launched the ESOP Guy podcast, which I highly recommend that you go and check out, which explains the process of the ESOP transaction from a business owner's perspective. So Phillip has over 30 years of experience in finance and business consulting. In addition to directing Berman Hopkins' strategic efforts, he is a certified valuation analyst through the National Association of Certified Valuators and Analysts. Phillip provides consulting services for a variety of business industries. And in this episode, we talk about what an ESOP is, why it might be the right pathway for you as a business, why architecture firm owners particularly, are moving into ESOPs. We talk about the valuation of an architecture practice. How does that happen? What are the processes involved? What kind of experts and other consultants do you need to make sure that you're getting a fair and accurate valuation of your architecture practice? And we also talk a lot about whether or how to determine whether the ESOP pathway is the right fit for you and your business. We talk a lot about the benefits of the ESOP. What do employees actually get? We talk about the enterprise value, the equity value inside of a company, and we go into the importance of financial transparency when your business is operating as an ESOP. So I think this was a really fascinating conversation and probably the most detailed conversation we've had here on the show about ESOPs, and Phil's expertise was absolutely second to none. So thoroughly enjoyed speaking with him. So sit back, relax, and enjoy Phillip Hayes. This episode is sponsored by Smart Practice, Business of Architecture's flagship program to help you structure your firm for freedom, fulfillment, and financial profit. If you want access for our free training on how to do this, please visit smartpracticemethod.com. Or if you want to speak directly to one of our advisors about how he might be able to help you, please follow the link in the information. Phillip, welcome to the Business of Architecture. How are you?
I'm doing great, Ryan. Thank you for having me.
Excellent. Well, very excited to have you on the show. You're a CPA by training, right?
Actually, no. This is where I'm unusual. I am a partner of a CPA firm, and I was actually one of the first non-CPA partners back in the early 2006, 2005 timeframe. And so that was kind of a new thing for firms back then. And then in 2010, I was actually the managing partner of a CPA firm. So, that's another kind of, back then it was a very new thing for a CPA firm to have a non-CPA running the practice. So, and it's part of the reason I think it's important is it's part of the approach to the market when we get to the topic of ESOPs that I think has been very effective, because we are a CPA firm, but to do the work that we do, it does probably take more of the disciplines of banking and finance, business valuation, M&A, and more of a somewhat of a legal background as well. So these are not necessarily CPA type of skill sets, and so it's kind of interesting. Like for us, we're able to do this kind of work, and then we get to kind of round that out with other CPAs to just be in the delivery process, be a lot more effective than just having.
So how would you describe your current role?
Yeah, so my current role is, in terms of the ESOP world, I would be known as a sell-side advisor. And so in an ESOP transaction, very similar to other types of what we call M&A transactions, merger and acquisition transactions, there's typically a sell-side advisor. Most of the time in the marketplace, you're looking at that being performed by an investment banking firm. And that's a very traditional approach. Hey, I'm going to sell my business. I'm going to have an investment banking firm help me through the process. So that's the sell-side advisory type of role. In an ESOP transaction, it looks very similar to a normal M&A transaction. So, and it won't surprise you that most of the ESOP deals that get done are done by investment banking firms. Mm-hmm. But in this is something we can talk about a little bit deeper, but really the differences between a normal M&A transaction and an ESOP transaction, I think are really important, because you don't necessarily need an investment banking firm. And the reasons is that an ESOP transaction is a regulated transaction. It's not like an investment banking firm that comes in and finds a buyer that nobody can find for you in a normal traditional M&A deal. In an ESOP transaction, we're going to a buyer group that are trustees that everybody kind of knows. It's a finite group. They put themselves out there as the buyer, and so you're hiring them. So the buyers are kind of a known entity. And then the other part of it is, in a different standpoint, is that the ESOP transaction is a regulated transaction by the Department of Labor, because an ESOP is a retirement plan. And unlike, like an M&A transaction they don't have any of that type of limitations. So there's no regulations technically on that transaction. On this type of transaction, the buyer can only pay what we call adequate consideration for the ESOP. So if they're buying it out from a privately held owner, they can only pay the fair market value price. So What does an investment banking firm really do? They try to pitch a larger or higher price, a higher multiple. In an ESOP transaction, that's not really even appropriate, because it's not like you should take the lowest price. It's just that the buyer can only pay fair market value, and the Department of Labor is watching that to make sure it's been done correctly. So that's where my role is very distinct from an investment banking firm.
Got it. So we're seeing a kind of rise in popularity of ESOPs in the architecture industry, both in the US and in the UK. They're kind of a very it seems like it's quite a modern thing. I don't know much about the history of ESOPs and whether it's a kind of an acquisition process that has got a long past. What are some of the benefits? Why specifically? Why does it suit an architecture practice?
Yeah,
is it kind of tax benefits as well? And
for sure, yeah, and especially if we're focusing primarily on the U.S. market. And the UK, I think it works a little different, although there's some overlapping benefits in the UK. But for the US, there's a couple major tax benefits and this is going to be pretty much for any business. So whether you're an architectural firm or not, the main benefit for the selling shareholder is that they can sell the shares of stock and defer their capital gains tax on the sale. That is going to happen only if the company is an existing C corporation, or if they convert the company from an S corporation to a C corporation at the time of the closing. Now that's a pretty big benefit, because the federal rate for capital gains tax here in the US is around 20%. So if I can defer a 20% differential on the sales price that was going to go to be paying taxes on, I can hold that money as a seller and use that for something else, right? There's a lot of, I wouldn't say a lot, but there's complexity to that. It's called a 1042 exchange, where you have to set up a qualified replacement property. And so there are some things to creating a 1042, but in effect, that's a pretty strong benefit for somebody to sell their company and not have to pay that tax. And in addition to that, the states have capital gains tax too. So those would be in addition to the federal rate. So it can be, for some states that have very high tax rates, capital gain tax rates, that can add a significant amount to incentivize them to do that as a 1042. So keep in mind, the ESOPs, this in the US, that's the only way you can do this. Like there's tax provisions that are only available to ESOP companies.
Right. Yeah. Well, so, I mean, perhaps it's worth stepping back a little bit here and kind of explaining, well, what are the main differences between a regular kind of acquisition of a company versus an employee initiated acquisition like we're talking about?
Sure.
Here, what are the main mechanisms that we need to be looking at? And
that's a great question. And so one of the things that's really significantly different, and this is one of the things I think are attractive to an architectural firm, is that the transaction for an ESOP will allow the owner who sold their shares to still be a very fundamental part of that company going forward. And so they can serve, and they may be ready to kind of start exiting the company, but they can serve on the board. They can stay in the position they were at before. There's no real requirement for them to change what they were doing before that happened to after the transaction. So that for some people, that's a pretty attractive aspect, because there's a lot of flexibility on the way that they go about their transition. And so small, closely held companies, especially like architectural firms, they've just kind of, as you've done it for 20 years or 30 years, you're just kind of used to it, and it's just part of your lifestyle. So for you to sell to a company and have to be walked out the door in a year or whatever, and it's a whole new company, that's hard for some people. So I think that's an attractive idea when it comes to why it would be a good beneficial thing. The other part is that the people that helped you build the company, your employees, are going to get to participate in this. Now a straight up transaction, the owner sells, they get their money, the new buyer comes in and they run the company, and they move on and you kind of leave. In the ESOP environment, you're going to sell your shares. Now, the employees in this environment are not buying your shares. This is a benefit plan for them. The shares are going to go into what we call an employee stock ownership trust. So you sell the shares, the company buys those shares and leverages the company with debt. Those shares go into the ESOP trust, and then they're going to be allocated to the employees over what we call a long-term benefit plan, or over a period of time. And so that's going to vary a lot, but essentially the employees, though, aren't paying anything for these shares. They're just part of the company as employees. If they stay there, then they're going to have the benefit, and we call them beneficial owners of the shares of stock, and actually become connected stakeholders to the future of the company.
So it's not like the employees then actually put their own money into buying stock from the current owners. It's like a deferred compensation type of arrangement.
They're not putting anything. Like in a 401k, though, in the US, you do put your own money in that. And then in some cases, the company matches that. And so that's a nice benefit for you as an employee. In an ESOP, you don't put any of your money in at all. The company is actually allocating you shares every year. So there's a stronger, and if you look at a typical 401k match, it's usually something around 3 or 4%. For an ESOP, it's typically around like a 12% benefit. So it's a significantly higher benefit. And I think the main difference is that you're going to participate in when you think about stock appreciation, like if you think about a small, closely held company, the ability to participate in the appreciation of that company's stock value is a pretty big benefit, because if I just buy in my 401k a lot of mutual funds and very diversified equities, I'm probably not going to have a very strong growth rate in my retirement plan. Most people aren't going to look for that. They're going to look for diversification. But when you think about where wealth is created in the US, and I'm sure this is true in the UK, it's really in these small, middle-sized, closely held companies where the owners start the company, and the value of that business has gone up so significantly over 20, 30 years. And this is the opportunity that the employees have, is to participate in that kind of major appreciation of value just simply by doing their jobs. Now, meanwhile, the company, most of the time now, we're going to be able to put that company into a tax-exempt environment. So the company's no longer going to have to pay any income tax either. So that means for most of these companies, let's just say 30% of that cash that was going to pay taxes is now coming back into the equation. That's going to help them repay the debt faster. And then once the debt's all paid off, we're accumulating more value because the company's accruing cash. And so when we talk about valuation, there's several terminology definitions that are important: enterprise value and equity value. So enterprise value is the value that we talk about when a company sells as a multiple of cash flow. You just sold by 10 times EBITDA or whatever the number is. That's what we call enterprise value. But equity value is that value plus the other aspects of the balance sheet, which include my accrued cash in excess of working capital minus my debt. So in the future, what happens is my equity value in an ESOP company is going to be affected by paying down debt, dollar for dollar increase in equity value, and by the accumulation of cash. not just the cash, the EBITDA targets or the multiple of EBITDA. Those are going to be a factor. So what an ESOP company gets to what an ESOP employee gets to do is participate in the accumulation of equity value, which if the company's paying debt down pretty fast, the value can go up really fast. And so it's a tremendous benefit.
So when do the employees then start to get a kind of dividend like this in a similar sort of way that they would do if they owned shares of another like publicly listed company, for example?
That's a great question. No, they don't get a dividend. They're what they're going to get every year is a participant statement showing the shares that they got in this plan. And every year they're going to get new shares. And so it's going to accumulate. So if I had 100 shares the first year, I might get 200 or 300 the next year. Those shares typically get allocated to the employees based on their compensation. So what hopefully is fair about that is that if somebody is compensated more, then maybe they have more value in terms of contributing value to the business, right? And if they get paid less, there might be a relationship there. And it's really just a good, easy way to do it. And that's really how most plans are designed. But what they're going to get, they're not going to get a dividend, but they are going to accumulate value in this retirement plan. And then when they do leave, that is going to have to get paid out.
Right. Okay. So when they leave, somebody or the business buys the shares back from the employee, or how does that transfer?
Yeah, exactly. So the business is going to start to accumulate what we call repurchase liability. And the repurchase liability is what the company is going to start to owe. So the first step of this, they pay off the owner, like they bought out the company or they bought out the shares of stock from the owner. So they got debt on the books and the company pays that debt off again with the tax benefits. Then individual employees are starting to gain value in their shares. And then eventually they're going to leave. And then in the plan document, the ESOP plan document, there are provisions for them to get bought out. And so at say they're ready to leave, let's just say they're retiring at 65. They've been in the plan for 20 years. Whatever the value is at that point in time, they're going to get that value. So if the per share value goes up every single year, it's not like an average. It's like the day they leave that year, that value is what they're going to get paid out. So whatever shares they have, that'll be the number. Now, most of the time they're going to get paid out over like a 5-year period. So they're not going to get all their money immediately, but they are going to be able to get that paid out. Or maybe they leave the company before retirement. They're going to be able to take that money, get bought out and roll that into a retirement plan, like an IRA or something like that.
I see. Okay. So it gets transferred. So they don't actually get to have the cash, but it's kind of their pension fund. Right. So part of the ESOP mechanism then really is it's like a long-term investment wealth building device for the employee. What happens if say the company has to make a lot of layoffs all in one go?
That's a good question, because it's very similar to any other benefit. They would have to calculate the vesting schedule. So like who's vested in the plan. If they were going to have to lay them off, that is their asset. And the company would have to buy that out. And that's going to be a business decision from the board of directors to say part of the layoff is we got to unwind some of these retirement plans that we've built up. Now, that really does infer that the company's probably not doing as well, right? So that could also be the value of the business could be coming down a little bit too. So if that's happening, then the value of what they're buying those shares out might be worth, not as much as it was before. And so what's nice about an ESOP for an employee is they do get to participate in the upside. If things are going up and they haven't had to put their money in it. But the reality is they're also participating, just like owners. If the company goes down in value, the value of their retirement is going to go down. And so now they should still have a 401k. They should still have other retirement planning means. But if the company is well run and they're able to do that, then most of the time we're as we do planning, we're going to get into this a little bit deeper, but as we do ESOP planning, that is definitely something that's on our minds. Is this company stable enough in its cash flow historically to do the transaction? If it's up and down, it may not work.
Well, it becomes interesting as well when the employees have this kind of responsibility and the sharing in the ups and downs of the value of the business. That I can imagine that one of the advantages of the ESOP is that it creates that culture where people are literally they're invested into the business themselves. This is ours, so they've got a responsibility to be like, okay, well, something's happening here. Like, what can I, what's my role to be contributing to ensure that we're not doing this. So everybody becomes interested in the business side of it. And for an architecture firm, that's massive. It's really massive. Important.
Yeah. Yeah. It's like let me put my ownership hat on for a second and really think about, if this is my company, what would I do? And a lot of times if people have never owned a company, they may not understand what I'm going to say, but most business owners that I know, if things get rough, they're kind of like, all right, well, we're going to do this, this, and this. And they've got a game plan. They're normally not going to say, oh, it's just too bad, I'm going down in value. They're normally going to meet the challenge like any business is going to have and figure it out. So possibly for an architectural firm, it just may mean that, hey, we know we've lost a couple of big clients. We all got to do more BD. We got to do more business development. We got to get more business. Or we've got a lot of business coming in. We don't have enough staff to take care of it. We all need to go recruit some really good people, build the talent. And so you're going to have people that will wear more responsibility in the company. And this is why an ESOP company statistically is going to outperform a non-ESOP company. And the numbers are always being calculated there, but it's I think ESOP companies outperform non-ESOP companies by 65% statistically. Wow. And so that comes through the NCEO, which is the National Center of Employee Ownership. But it just makes sense though intuitively, because you are affected. Hopefully, you are affected if you're an employee of an ESOP company by, wow, this really does matter now. It's not just a clock in, clock out job. I have the opportunity to really build some wealth, and what you do want to do is take a good culture and make it better with an ESOP. I have a company that has a good culture. Everybody likes working there. How do we take an ESOP and make that better? And this is where it gets better, because people now can be connected to that, all of them, because they all win.
So what kind of companies would you recommend are suitable for ESOPs, and what kind of businesses are not?
Yeah, it's probably mostly not as much the industry, but I do think architectural stuff, as we go through there's some reasons that architectural firms are a good fit. It's, to me, more of some other factors. So the first is the owner's mindset that owns the company right now. Is their mindset one where they want to plan their, if we call it exit planning or succession planning, all this kind of happens connected. Are they thinking on a bigger picture and a bigger scale? And in the factors that they might consider, of course, the valuation is going to be important to them, but other parts and pieces are going to be important if they're a good candidate for an ESOP. And that is, do they care about how the employees are going to be treated in the future? Do they care about the future legacy of the business that they built? And is that going to be important enough for them to build into what the deal might look like for them? So some owners that I talk to, and there's nothing wrong with this. I'm just kind of pointing out that they're probably not a good fit for ESOP. The only thing on their mind is, I want to maximize the valuation, and I'm waiting for the next big wave of private equity group deals to come through, or the next big strategic buyer to come make me this big old offer. And if that's the only thing on their mind, I usually just tell people, you're probably not a good fit for an ESOP, because you want to have the connectivity of a very holistic picture in your brain. Like, how do we do this and also help the employees? How do we connect this? It's not either, and the other side of it's not true either. I'm not just thinking about the employees. There is a balance to it. So that's the first thing. The second thing I would say is, people do wonder about this, like the size of the company. Will it matter if you go through an ESOP transaction? Now, I would say very, very small companies, I would say less than $500,000 of net income probably aren't a good fit for an ESOP. Anything above that probably could work as an ESOP. There are people in our industry that would say they don't even touch it if it's not $5 million of EBITDA. But the problem with those people are they're more thinking of having an investment banking firm do the transaction. And so the way that we have gone about it as a sell side advisor is a very cost advantageous way, because we're not charging a success fee, and we're not charging a transaction fee, or we're not charging a contingent fee based on the purchase price, which I think philosophically it doesn't really make sense to me, because we are dealing with a regulated M&A transaction. So size is going to be important. If you're too small in a number of employees, we may have to shift you to a C Corp as opposed to an S Corp. I have one transaction I'm working on right now that they're a great company, but they're 10 people. And so instead of being an S Corp, we'll be a C Corp, because an S Corp has to follow there's a 409P ruling from the IRS. So there's disqualified persons test. So a company that has very few employees can be restricted that way. So I think it's the mindset of the owner, and it's kind of the size of the company. And then it's also a matter of predictable cash flow. So if I have a company that's losing money every year, or maybe they lose money every 3 years and it's just very volatile, probably not a good company to do an ESOP, because you're going to have to structure this around cash flow. And if the cash flow is not there to do the buyout, there's really no tax benefits, because you could have losses. That's probably not going to be a good fit. But I think those are probably good for just in general for businesses that work or don't.
You touched upon kind of briefly a little bit earlier about the valuation process of a business and preparation for an ESOP. Talk us a little bit more about that, and sure. How, people considering going on to this journey to becoming an ESOP, what sorts of things should they make sure that the business has got in place to get a solid valuation? Awesome. That's fair for everybody.
I think that's a good question. And you mentioned the journey to an ESOP, and I think you probably already put this in your comments, but I do my own podcast called the ESOP Guy, Journey to an ESOP. And, I wanted to put that in there just because I think it's important for people to, if they do listen to this, they're like, hey, I've got more thoughts. I want to know, I want to learn more. Go to that podcast, because there's a lot of information there. The valuation is something that at the very beginning of the process, like we're going to want to nail down what we believe the company will sell for. And so if you back up a step, a lot of times when people are thinking about an ESOP, they're conceptualizing like, how does this work? Kind of a lot of stuff that we're talking about, like, if you conceptualize the way it's going to work for my employees and it's going to work for me as the shareholder and financing, the very next step after that is like, okay, you think 90, you're in a high probability of saying this might work for you. You're going to have to get into the valuation, because you're going to have to nail down, for the business owner, what's this going to actually reap you when you actually do sell it. Now, without getting into too much detail, the valuation that we work with is a model that anticipates the way that the trustee and their valuation firm on an independent level are going to come up with the number. So I mentioned this is a regulated M&A transaction, but it is an M&A transaction. We are the sell side advisor. Eventually, we'll be hiring, and with the client, we'll be hiring a trustee and their valuation firm to do very formal work. We're going to do some informal work, but it's more modeling. And what we're trying to model primarily in the valuation is how is the forecasted cash flow going to impact the value? Now, that's a really tough thing for people. And as we get started, I've got a lot of projects I'm working on right now. Helping someone build a 5-year forecast is really difficult. Nobody knows the future in 5 years. Nobody does. And even in 1 year, it's tough, because
even in 6 months with many practices.
Yeah. So, but I, oddly enough, most of the emphasis in valuation for ESOPs is going to be placed in the discounted cash flow, which is a income approach valuation method that is going to lean towards forecasted cash flow. And so the forecasts do need to be worked where they've got integrity to the models. They make sense from a business plan perspective. If the company has a history of say, 5% growth and the forecast is showing 50% growth, it's probably not going to work, right? So there needs to be a very reasonable forecast. And the other piece of information in the valuation model that needs to be built is the working capital targets. Because I've seen this where I've actually picked up some clients that actually working with other advisors, and then they hired me, and I look at their stuff and they don't do anything to estimate working capital. So one thing that's true about any small, closely held company is the amount of cash they keep on the balance sheet can vary. Now, some smaller companies that do business, this is architectural firms too, they can keep a lot of cash on the balance sheet. Is that going to affect the valuation? Absolutely. Now,
Right.
how much it will affect will be based on the target working capital. And so if you don't estimate if you don't estimate them appropriately, then you could really be either underestimating or overestimating your valuation, and you're coming out of the gate with bad information. So
Right.
we're going to build a model that will help do that, and also we're going to build a model that will help update through the entire transaction, because you're looking at about 6 months from when we first start doing a valuation model to the closing. So,
How,
and a lot can change in 6 months.
so how would the valuation process differ from, say, it was a private acquisition?
Yeah, very good question. So a private acquisition, if you come in and you're the buyer, a very traditional approach to doing this is you have a meeting with the owner or the board. Hey, we really like your company. We're the suitor. We're going to issue you at the very front end, after some very small information is gathered, like financials and stuff like that. We're going to issue a letter of intent at the front end. And the letter of intent the buyer is going to issue is going to have to be proven out through their negotiations. So they're going to start with some number at the front end, and then they're going to work their way through a transaction. Now, the basis of that number is going to vary widely based on the strategic nature of the suitor's interest. So if they're really looking at it might not always be cash flow. They may want the technology. They may want the customer geography. They may want something in there that's very strategic in nature. Their
Right.
valuation may be very geared towards the market approach. And in an ESOP transaction, although that's in there a bit, most of it's geared towards cash flow and the what we call the discount rate or the capitalization rate of that cash flow, which is basically the risk rating of the business. So certain industries are going to have higher risk ratings than others. So a construction company might be higher than, say, a doctor group, and so if you're going to want to understand value, good valuation theory, but also practical approaches to doing a model that's going to make sense. And so our job is to predict that number and make it reliable for somebody to plan the rest of the ESOP transaction around it.
Right. And so as you're moving along this process of becoming an ESOP, who are the other, what's the kind of team that you need to be creating? What kind of
That's great.
professionals need to be on board?
That's a great question. So the way that, my first approach to this is I don't want to encumber the company with a lot of costs at the front end.
Right.
And so I want to help them to what I would call prove out the ESOP concept. So they could say, my tagline is the ESOP guy, right? And it is, and I've branded myself that way, but I'm not. I always tell people I'm not trying to create you to become an ESOP company. I want to help prove it out first. So the first part of it, after we get done with our work, we're going to nail down before we hire anybody else. This is first off, our plan is 100%. We've done all the cash flow modeling. We've done all the warrant modeling. We know this is going to work, and the client's collaborating on it. Their confidence level is very high. And so we're not going to hire anybody. But the very first person we will hire or institution is the trustee. So the trustee is going to represent the buy side, the buyer. And so to do that, we're going to interview the trustee, make sure that they're going to fit. We're going to interview multiple trustees so that the seller who is selling their shares has done the fiduciary responsibility of making sure that they haven't just picked anybody. Now,
Right.
the trustee is going to hire a valuation firm. So they're going to be an independent valuation firm. They're going to be part of the buy side team. And then they're likely going to hire an attorney. And so all of those people are going to be paid with those respective roles by the client. And then on our side, good.
Was there two valuation teams then? So the kind of current owners has their own valuation team, and then the trustees have their own valuation team?
Technically, I'm their valuation team on the sell side. It's like that very first step of doing the valuation model so the sell side advisor will be the valuation consultant to the client as part of what they do. And that's where we were talking about the skill sets of, being like me being a banker, a CVA, Certified Valuation Analyst, doing M&A work, having some legal background, all of that I think is an essential skill set for somebody to do sell-side advisory, because they do need to be able to consult on the valuation going through the process. And so now on the trustee side, they need somebody that's, because of the Department of Labor, that is completely independent. That firm has to have nothing to do with the company, had never worked for the company at all. It's very important, because there's a lot of any ESOP case you're going to look at ever legally, the problem always comes back to the valuation. And
does that regulation exist then in a private acquisition, or can you use one valuer? But it would kind of be a bit crazy if you only had one valuer, right?
Yeah, and I think the rules of truly not trusting people are going to exist in that. Like, I think the seller is going to be like, I don't care about what your buyer thinks. I'm going to get my own person. So I think that'll play out. And there's no technically regulations you couldn't. It's just you'd be kind of silly to accept something.
Yeah. Well, I mean, it's interesting when I've seen kind of deferred compensation plans or ownership transfer from an existing partnership team to a new partnership team, not as an ESOP. I've seen it many times where the architecture practice has only ever had one valuation, and often the new partners, they're just accepting whatever the valuation is that the people who are selling it is, and it's kind of based on a lot of trust. But often that can break. Yeah, and that can break down after a few years when everyone kind of starts to get a sense of actually how the business is operating. And sometimes people who are now becoming business owners or becoming partners, well, they were architects. They didn't have an interest in business. They didn't even know how the business side of it worked. They didn't know what to look for.
Yeah. And I think with that too, I think it's a good point. A lot of the consulting I've done that's not necessarily ESOP, but it's just like internal buy-sell consulting with internal agreements, is if you've been through this with maybe a minority partner suing a majority partner over these kind of things, it does happen. And what I try to do if I'm helping somebody structure something, I'm trying to educate the whole group on valuation, because you do see a lot of confusion in the professional world, like with architectural firms, about what should this be valued? What's, for instance, like, what's my book value? How does my balance sheet translate to the actual real value? How do you keep it if you're going through the appreciation of, like, somebody signing a shareholder agreement, and then 10 years from now, what's going to be that value now? And a lot of these agreements, they're built around, hey, if we're gonna separate, or you're gonna leave, we're gonna go out and get some valuations at that time. But that's always kind of a recipe for some type of lawsuit, because maybe you're not okay with that valuation, and maybe and so now you have this potential problem. Or someone dies and the spouse says, no way, this company's worth way more than you're saying on this agreement. So they sue the partner, and it's like, that's a mess. So it's way better to nail this stuff down. And that's really one of the byproducts of doing the valuation models. They may not even do an ESOP, but they could probably use our model to help to build that buy-sell agreement to really strengthen the company's understanding of what valuation really is, so that everybody's treated fairly, whether you're a minority owner or.
So what happens if you're on the kind of the sell side advisor position? You've come up with a valuation of the company. Then there's the leaders of the trustee or the trustees. They've got their independent valuer, and the two are kind of wildly different. Does that ever happen?
It's a great question. And that gets asked like almost every time I take on a new client. To be honest with you, and it sounds crazy, but no, it actually never happens. The work that we're doing is to create some scenarios, but and it comes back to the skill set. Like, I'm filtering the information that they're giving me. And once we get really close to finishing the valuation model, at the very beginning, I'm actually just going to play the devil's advocate. Like, I'm going to act like I'm the trustee evaluation team, and I'm pinging them with questions about your customer concentration. How does, management depth affect your risk? How does, your geographic limitations, your boundaries, legal, legislative risk, all of these things that I know are going to come. I'm pinging all that. So I'm already filtering that. And then, so that's why the modeling isn't just putting numbers into, say, a spreadsheet. There's a lot more of 30 years of experience coming into that, and, so I think that's important. And I think to say this is like, what's really important is you find an advisor who knows how to do that. One of the things I think it's interesting, like I don't want to be demeaning at all, but a lot of times the investment banking firms, they're just putting together a PowerPoint and there's like some multiple of EBITDA. I'm like, well, that might be the multiple that they negotiate, but there's no roadmap of how they got there. Mm-hmm. So what I'm doing is I'm going to give somebody a roadmap and I'm going to help them understand. And then I'm getting their assistance collaboratively to make sure that all of my assumptions are done correctly, as opposed to I'm going to back in on something I think already exists and then just kind of say, hey, that's what it is. And then trust me, let's move on. We don't do that. It's too important of a thing, as you've identified. It's too important of an issue to wait or worry about later.
So when we've got this transfer of ownership happening into the ESOP, and let's say that an existing partnership team retires and disappears, and there hasn't been a transfer of skills, for example, there hasn't been a proper transfer of the ownership, the owner skills that are needed, like winning work, for example, or dealing with the actual mechanisms of running a business. And now you've got a group of architects, amazing designers, amazing architects, but they haven't got a clue on how to win work. Now, all of a sudden, the company starts to diminish in value. What do you recommend to make this transfer effective? Sure. Yeah. And like, what sorts of education is needed for the trustees, because they've got a new responsibility now?
Yeah, good question. And let me back up in this process a little bit, because what you're getting at is I always call it like there's two transitions happening: ownership and management. Mm-hmm. And what's cool about ESOPs is we have a lot of flexibility on timing. Now, in some cases, where when I come into the play, the ownership transition the management transition is 100% done. The owner tells me, hey, I'm not even coming to the office anymore. I'm out golfing every day. I still own the shares. So of course that's easy because it's already being run. The company's already being run right now. It's like, that's a piece of cake. Now we just have to focus on ownership transition. Now the other extreme exists as well. The owner's like, I am working 70 hours a week and I want to do the ESOP so I can get out of here. And I'm like, and so part of that beginning is like, I'm going to kind of give them some advice on, look, the ESOP transaction is not going to free you from the bondage of your job. It'll free you from the ownership and all the things you might be feeling, but that's not going to do it. So we're going to have to build a management transition plan. And that's something that if people are listening to this, I'm like, you can't start that soon enough, right? I mean, whether it's in a very, it can happen in small degrees. It's better that it happens in small degrees. It's better when you recruit talent and you bring them up slowly, as opposed to bringing somebody in from the outside culturally, trying to get them to fit. So, but there are cases where, like I did 100% ESOP for a company that the guy was in his like early 70s. And he's like, I just want to do the ownership transition. I still want to manage the company. I want to be the president. And he's 76 now. We did 100% ESOP and he's completely fine with it. Like he works 12 hours a day. Now he has people behind him that can do his job because we've worked on that over the last several years. But going into the ESOP transaction, we were still him 100% president and everything. And we did 100% transition. So that's kind of an extreme example. What I'm trying to say is like, there's a lot of flexibility though. And the ESOP can be a great tool to be the catalyst for a management transition plan. So sometimes we're like, all right, we're going to kick off this and you're going to still do the same thing, but we're going to get you in 5 years from being 100% to 80 to 60 down all the way out. And we've got these people in place. They're going to take on more. You're going to take on less. The reason that's very successful is because sometimes the owner can't let go until they actually don't have the income from this anymore. Mm-hmm. if they still have the income and the cash flow, they're going to want the influence and all that. So once they lose that piece, then their inability, their mindset is like, okay, I'm ready to release the control thing I had, like control problem I had. So, and honestly, I love management transition planning because it gives the people that have talent an opportunity to do the thing that they really want. And if you don't give that to them, you could really jeopardize the whole company. So now, in addition to the ESOP, we're going to use other tools to incent a management transition plan. Those are going to be things like SARs, stock appreciation rights programs, that'll be kind of built into an ESOP transaction that could be used separately. So they're not necessarily just an ESOP creation. They're created as a legal contract by the company to the employee, but we use them, with an ESOP transaction as synthetic equity for people that, because the big question that I think is stirring around too is, if I am working as the new owner, not the new owner, but the new president, and I'm putting in 12 hours a day, and I might be getting more shares in ESOP than somebody else, but I should get something more than that because I'm just like, I'm working my brains out. I'm like on the front line. So we're going to build in an incentive plan to affect that strong transition for them to stay president, to stay rewarded, and to be motivated to build the future value, which is going to help everybody. And that's a key ingredient for any architectural firm or any other company where you have to have the leadership in place.
So this becomes interesting, kind of arcing back to the question of valuation, and the obviously the value of the company is can be shifting over the process of the ESOP transition. And if you're moving from, say, like a single person owner who's led the business for the best part of 30, 40 years, for example, and everything's in their head, I would imagine as soon as there's this management transition plan that happens, actually the value of the business suddenly rises. Because now the business is a business as opposed to it just being one person.
Yeah, you kind of like the terminology we use here is like it's a lifestyle company, and the lifestyle company analysis is like the business is basically going to take on the person's lifestyle. If they're whatever a single owner does, it's like that the company revolves around that, and it can be dysfunctional sometimes, or it can be very functional. As we transition to a management team with a board of directors, and then these more professional people that are running the company, we move into more of the business, like a more normal business setting of business management, as opposed to a lifestyle company. So it can be more valuable in the future that way. And it really is part of the valuation in the first part. So let's just say I have a company, same exact type of company, but they've advanced their management plan in the ESOP transaction. Maybe they're down 3 or 4 steps, or they're 100% through the management transition plan. They should be worth more dollar for dollar than the company that has a single owner that hasn't done any transition planning. In fact, they will be. And part of the way we use that is we'll end up doing a management presentation to the trustee and evaluation firm as one of the steps along the journey to an ESOP. And that is called a SIM, or a confidential information memo, that we put together as part of the site visit. And so in that, we're going to dig into who are these people? Like, what are their resumes? Why are they qualified? How long have they been here? What are their roles and responsibilities? How effective are they? What are their KPIs? How do they manage? How do they take the company more from a business process to, just managing it by the hip or whatever. So those things are absolutely going to be enhancing the value of the business. But if we don't get there till later, then the value can go up later as well.
Got it. Is it reversible?
An ESOP?
Yeah.
Yeah.
And have people ever done that?
It happens. It does happen. And I think some of it happens because they've got into it. Let's just say there's a scenario where I'm just going to pick on the investment banking firms. They overvalue the company. They went through this process, paid a bunch of money. The company has way too much debt. Nobody did the right planning for feasibility to figure out if this was sustainable. And so now it's not working. Like, it's effectively not working because the company can't meet the demands of the cash flow that's requiring. So what they would have to do is the owner could just buy it back, or it could get, if it goes down in value, of course, it can go through some transition. So then it could be unwound. But my biggest thing on that is if you would want to plan accordingly to not ever have that happen, because you've wasted your money on the transaction, you've wasted the time, and you've steered the employees in the wrong direction from a culture standpoint. And so it could be super disruptive and confusing. Another reality, though, for a lot of ESOP companies is that they get to a point through the ESOP that they're succeeding so much that they get bought by a strategic buyer.
Right. Okay.
And that'd be a very positive thing, because now everybody that works there, they get their shares, they get the money, and everybody is going to benefit if we do that. An ESOP company would have to sell above fair market value to an outside buyer in order for the trustee to say, yeah, we're good with the sale.
Right. Yeah. In terms of culture shifts that you typically see within an ESOP company from going from privately owned to ESOP, what culture shifts do you typically see happening? What culture shifts must happen for it to be successful?
It's a great question. Let me bring this back to the context of architectural firms too, because I think that would be kind of helpful. So for any company, I think the first step and part of what I'm trying to assess is what is their culture. So for an architectural firm, a lot of times, when we define the culture going into the transaction, we're looking for certain elements of say a culture of teamwork, a culture of people. There's an atmosphere of, people like their job. They like the environment. There's a friendliness to it. Maybe a work ethic, but there's a balance where it's not like they're not in the slave driver situation where everybody's just killing themselves and all that. So those are kind of, I would say, cultures that I've seen with architectural firms and other companies that I think are super positive going into it. Yeah. And that's probably one of the reasons that the owners are stopping and saying, you know what, we don't want to lose what we have here. The firm I was telling you about earlier, the architectural firm we just did their ESOP for, they had somebody come in and kind of help them build a culture over the last several years. And it just energized everybody. Like, they're just so excited, right? But meanwhile, they were left with this issue. They had the two oldest founding members were at a place where they were ready to retire. They had 6 other partners. And because the company's, not just their culture was great, but their value started to go up significantly, they ran into an issue of affordability. How could the other shareholders look to buy them out? That was starting to become an issue. So ESOP became a very good avenue for these guys to understand the connecting points, that they could keep the culture they built, keep the same people in place leading the company, and at the same time now enhance the culture with the ESOP. So now these are going to be things that they're going to start working on. But the things that I think are really important is to connect the dots and educating people on how this thing actually works, how it works for what they get out of it, and what they're going to have to do on their side to build their own value going forward. And so those things can really resonate in a culture that's already good. And they can kind of give kind of a little bit more connectivity to the meaning behind it all, right? So a good culture without an ESOP is like, hey, we love working here. We probably would love working somewhere else too. They have a good culture too, right? The difference now is that I've got a stake in the work I'm doing every single day. So whether that's Monday through Friday or whatever I'm doing with this client, I can see that work sticking into my future in a way that's meaningful. So I did another architectural firm about a year ago. This was about a year ago from now. And they were under, from a culture standpoint, they were in a program called Great Game of Business. Have you ever heard of that?
No, I haven't heard that one specifically.
So Great Game of Business is a business management philosophy and program that fosters open book management. So open book management is when you literally open the books to everybody in the company. And in their company, they'll have like weekly huddles. Everybody knows their number. Everybody understands what has to get done. So like in their case, it was interesting because they already had a very financially literate employee base because they were already educated on the financials. And so doing the ESOP has made that even better, right? Because now not just are they literate, are they connected to the understanding of how that really translates to the value. So these are just kind of like what I would say culture is so important. What I would say on the other side of things is though, if the company has a bad culture, and nobody's going to say they have a bad culture, by the way, but it's not going to be the answer. If like to say the indicators are there, the turnover is high. The people are putting on job vent and social media how much they hate this place. I mean, there might be signs that the culture's not great. I would say ESOPs are not going to fix that, right?
Yeah.
It's not going to be like, oh, great, I'll plug an ESOP in and you got a business management problem there. You got a communication problem. You got other things that need to be figured out first. So people that come in the door and say, hey, I want to think about an ESOP, I'm never going to tell them it's going to be your answer to a culture. It's going to be an enhancement to that culture.
Amazing. I think that's a perfect place to conclude the conversation there. If people listening to this podcast, they're interested, they're in partnership conversations about becoming an ESOP and they want to speak with you, what's the best way for them to connect with you?
That's a great point. So I would say go to my website at journeytoanesop.com. And then there's a contact me file there. You can just ask me a question and I'll that goes right to my email. If you wanted to email me directly, hayes@bermanhopkins.com would work. And
right.
So either way, it'd be great to connect with people that are thinking about this. So I think to leave off with, I think it's perfect for architectural firms for a lot of reasons. I think that architectural firms have the employee base that can definitely understand the connectivity between ownership and what they do. Not that other companies can't. I just think that fits well. A lot of the ways architectural firms are structured, they're much more team oriented. And I think that works really well for ESOP companies. And then just like we've been talking about, I think cultures really work well. So that type of environment is a great fit for an ESOP company. So, but
amazing. Brilliant. Well, I'll put all those details into the information on the podcast. And Philip, that was incredible. So thank you very much for sharing your expertise and insights there into the journey to an ESOP.
Ryan, I appreciate it. Thank you for having me.
And that's a wrap. And don't forget, if you want to access your free training to learn how to structure your firm or practice for freedom, fulfillment, and profit, please visit smartpracticemethod.com. Or if you'd like to speak to one of our advisors directly, follow the link in the information. The views expressed on this show by my guests do not represent those of the host, and I make no representation, promise, guarantee, pledge, warranty, contract, bond, or commitment, except to help you be unstoppable.